The second coin in the Heroes SD War collection, Revolution, is available now at SD Bullion. Available in BU and proof versions, with an extremely limited mintage of 1,776 numbered proofs, each honors one of the original signers of the Declaration of Independence. These stunning coins are once again sculpted by the world-renowned Heidi Wastwheat. Grab your Heroes Revolution coins today at SD Bullion. This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Joining us today, once again, is the silver guru himself, David Morgan from SilverInvestor.com. Thanks for joining us again, David.
It's my pleasure. Thank you.
We had the Fed tapering again on Wednesday of this week, tapering another $10 billion, at least the official quantitative easing, down to $30 billion a month. We were quite surprised. We didn't see much action in the aftermath of the announcement on Wednesday afternoon. We have seen a bit of a typical sell-off the day following the FOMC release here on Thursday. We're recording this show this week on Thursday. Silver trading down to just above $20.30 an ounce in New York trading this afternoon on Thursday. In gold, after being capped right at that 1,300 level for about the 24 hours leading up to the FOMC announcement, is down about $20 off of the news, down to about $12.80. So what's your take, David, here on the metals tradings off of their earlier highs from 2014? We were well above 1,300 in gold, and silver was I think we saw north of 22 for a little while, down towards support again at $12.50 and $20. What's your take here on the trading this week in the aftermath of the FOMC statement, David?
Actually, I'm somewhat encouraged by it. I mean, first of all, I'm on record as saying that the low for silver is in. I think the gold low is in, and the silver low was over a year ago. It was 1817 intraday, and it came up, and it was a key reversal. Those things are called key reversals for a reason. You can look it up on the internet if you want to learn more about it. After this announcement, I think had this happened months ago, you might have got a bigger reaction you've gotten. Of course, one day doesn't make a market, one of my favorite expressions. I think we're still building a bottom. Both the metals. I think they're being very stubborn. They're not giving up a lot of ground. No matter what's being thrown at them, they're not going lower. On the other side of the coin, and try not to talk out of both sides of my mouth, you've got all of this geopolitical tension going on. It seems to be increasing. And under quote-unquote normal conditions, you would expect, a move up in gold particularly with what's going on with, this global conundrum between what's going on in the Middle East and Israel and everything included, and then of course with the situation with Putin, where he's all of a sudden the bad guy of the month or the year. So a lot of countervailing forces that you're seeing on both the positive and negative side. But overall, taking a deep breath and looking as objectively as I can, I'm pretty pleased that they're not getting, hammered any lower than they are. And I think they're going to stay in this range. I don't think they can go much lower. So I still think that the base is building. And remember, the longer the base, the bigger the move up. And we've certainly been basing for quite some time in both the metals.
Reflected in sentiment for precious metals investors, both on the mining shares as well as the physical metal. It just seems like the consolidation has been an extended period of time, and like you allude to, David, that really just provides an enormous pent-up energy or spring-like possibility for when the next major bull rally finally begins.
Yes, I'd agree with that. It's I coined the expression, or I think I did, of, these metals markets will scare you out or wear you out. And they can scare you out on the long side if you're short. Well, we saw, in 2011, where silver went from 19 to 26 and 26 to 48 and did that rather rapidly. So if you were on the short side, you were having a religious experience. On the other hand, we've been in a 3-year bear cycle within a secular bull market. And it's definitely worn out a lot of bulls. I mean, there's a lot of people that I know that were very bullish in the market, especially above the $30 level in silver, that now don't want to have anything to do with wish I'd never heard the word, etc. So using sentiment as an indicator, that again shows to me that we're probably near the end of this. Who knows exactly when, but normally these large consolidations take 2 or 3 years. We're a little over the 3-year mark in silver, and it'll be September, it'll be 3 years for gold. So again, I think we're getting near the end, and we will start to see it work its way higher. I don't expect a big move up or a substantial move up, although I don't rule it out because of everything that is happening geopolitically and in the physical world itself, metal-wise. Nonetheless, I don't expect that. I expect it to work its way higher, get to another level, people not buying because, it's going to fall down again, it's going to bottom again, and it works its way higher. And, now it'll pull back, look at this report, look at that report, look at this, and then work its way higher, and all of a sudden, gold's back up to 1550, silver's back up to 26, and people that could have bought it, at 20 and 1250 respectively, or under 1300, will wish that they had, because 6 months from now, approximately, that's what I expect for those moves. It's like, not that 26 is very high or 1550 in gold is very high, but it's much higher than it is today on a percentage basis. So certainly, I think the best plan is to know why you're buying the metals, be educated, and have a plan of discipline. Buy over time, and buy when they're in the area they are now, which is basically the cost of production for gold and silver for both primary silver miners and primary gold miners.
Probably worth talking about the geopolitical connection with the U.S. dollar, and also the historical patterns of the cartel just beating the stuffing out of gold. When any particular event on a geopolitical front manifests, the short term usually brings out the Cretans to attack gold, and we've seen a couple examples of that, like, for example, when the plane was shot down, and then our specific reports about that hitting the news, and then artillery firing being claimed, and each time you see downward moves in gold, which are counterintuitive and counter to your typical expectations with economic patterns throughout 5,000 plus years of history of gold being a safe haven, but not in our current day, because gold is a threat compared to preserving the dollar and then treasuries as a status of safe haven flows. And we're seeing a lot of money flying into the treasury market to park itself as a safe haven. If you look at a chart of the dollar index, just the standard 6 currency versus the dollar index, the DXY, and you look at it from July, it just took off like a scalded cat. It broke down under 80, and everybody gets very nervous when it gets around 80 and slices through it to the downside, because that's been a level of general support for a long time. And then all of a sudden, you see it hitting 81.51 as of yesterday. So the geopolitical front, the issues with the Banco Espírito bankruptcy and the rising prospects for a deflationary style domino chain being triggered within the financial system is also creating the very short-term jitters that give pressure to gold above and beyond what the cartel does. And in 2009 we saw a perfect example of how in the short term both cartel piggybacking on deflationary rush to liquidity by some weaker hand investors and money managers exposed to portfolios that have risk to credit default swap positions and whatnot related to weak banks can create a lot of short-term turmoil. And at the beginning of last month, it looked like gold and silver were poised to just keep roaring, and then all of a sudden, by a week and a half ago or so, the momentum died, and here we are. It's just amazing how quickly the situation has turned. But the fundamentals remain strong. Long-term geopolitical risks will underpin higher prices for gold and silver, and on the ongoing supply and demand front when it comes to the reserve status of the U.S. dollar and trade patterns, and just this week is another example. Russia and India announced that they have been in high-level discussions to conduct trade directly with each other by swapping their own currencies to facilitate that trade. So these are all stories and trends that we've spoken about on almost every other show that we've done for the better part of a year now. It's nothing new, but the progression of these things continue. So it's a push and pull. I guess that's a pretty good segue, too, to talk about this perennial debate that the precious metals community has when it comes to, are we going to see a deflationary crash first, or is it going to be an inflationary style crack up boom type of progression? And David, you look at that question all the time, and would love to dive into it with you. What do you think's going on now?
Well, first of all, I've never ruled out deflation. In fact, I really started more in the deflation camp than I am currently. And I'll be the first to say I'm not certain. I think anyone that's smug or whatever is not open-minded. But first of all, the best study on what gold does, first of all, let me state, more important than anything, the metals are known to be inflation hedges, but the metals are crisis hedges. And I think Doug Casey says that the most often. They are something certain in a very uncertain world. So if you look at it objectively, an ounce of gold or an ounce of silver never changes. It's a constant. It's an absolute. The mass of those two units stay the same anywhere in the universe. So they're a constant. So Roy Jastrom, Professor Jastrom, wrote a book called The Golden Constant. And what he wanted to determine is if gold is a inflation or a deflation hedge. And what he found out was that gold does the best as a deflation hedge. But I must state that most of the time that he did that analysis, gold was money. So if you further that study, and Jim Poplava has done the best job of that of anyone that I know personally, he studied it further and determined that any time that there has been a non-backed currency, in other words, a pure fiat currency, that deflation has never taken place. Now, again, I'm saying I'm not ruling it out because who knows? This time it could be different. Silver, on the other hand, after Professor Jastrom got done with the golden constant, he wondered what silver did in an inflation and deflation. I made a whole lecture out of this several years ago, but the bottom line is silver's mixed. He wrote the book called Silver, the Restless Metal, a good title. And silver does, sometimes it actually does well in deflation. Most of the time silver does better than inflation. And I forget if it was at the forward or at the end, but Professor Jastrom basically stated emphatically that if you have an inflationary depression, the one and best place you could be, bar none, is the silver market. And I think he wrote that in the 50s. Or late 50s or early 60s at the latest. So coming back on point, what's taking place is, I'd say, countervailing forces. People confuse rising prices with inflation. Inflation is an increase in the money supply. Being pretty studied in the Austrian school, we have had inflation. That's indisputable. That's a fact. Nonetheless, what are the results? And the results are the banks are liquid, but that money hasn't really gone into loans. You're not seeing it pushed out into the common place where you need it to be for a crack-up boom to occur. Nonetheless, it doesn't mean it won't occur. I've always stated, and I've been consistent here, it doesn't mean I'm right, but I'm very studied on the topic and learning more, that we won't see any hyperinflation. You might see it in a few areas. You might see it in certain products here and there. But the bond market's a countervailing force. And if the dollar is a safe haven, and it's absolutely mandated by the mainstream financials and the mainstream media that the dollar is the safe haven, and that's a brainwashing mechanism that goes globally. Because if you've got a billions of dollar problem, are you going to park it into gold or $500 billion? You might want to, but you've got a problem. You've got too much paper to stuff into the gold market, so you're going to keep it in treasuries or you're going to put it in the near-term whatevers, and you're going to stay in dollars. And that is the perceived safe haven. So I could argue both sides. I really think that you're going to see inflation and you're going to see a move to the metals. Remember, only 1% of the population of money, I'm talking that money can think, and of course it can't, but the people that have money, that have the decision-making capabilities, only 1% of that is into the precious metals. So it wouldn't take a lot for the doubling of that to occur. So the 100% liquidity that's out in the global empire of fiat currencies worldwide, if 1% are in precious metals now, to see that double to 2% is not a stretch of the imagination at all, where people say, I don't care what you're making me do or want me to do, I'm going to buy gold, I'm going to buy silver. if that were to happen, and I believe that it will, think of what a double demand of physical reality would be into the paper paradigm. I'm still very bullish on the metals. I don't think it doesn't take a lot of people. It doesn't take 100% of the market to wake up and see what's really going on. It takes maybe another % of the market to wake up and say, I want to protect myself. I don't want this promise. I don't want this paper paradigm. I want something real. So I lean more toward the Jim Popova argument that it's never happened. It'd be the first time where paper trumps gold if it were to occur. I'm not betting that way myself.
And David, that 1% asset allocation that you just mentioned, I don't have the numbers right in front of me, but if memory recalls, the last bull market high in the early 1980s, the precious metals allocation was somewhere close to 20 or 25%, if memory recalls. So obviously that's a drastic increase from the 1% that we're looking at here today.
Right. And you know, it's hard to get a handle on those numbers, and I'm just doing the best I can. But certainly the idea is more important than the number itself. But the idea is correct. There's less in it now than there was in the peak of 1980 for certain. It was really a one-off, meaning a United States phenomenon. I mean, Nixon put on price controls when inflation was 4%. I mean, the true inflation is probably about 9% if you look at John Williams' shadow stats. And, you know, go to the grocery store. So, you know, the people are so undereducated, so ill-informed, and don't want to face reality. It takes courage to face reality. There are people that I, you know, talk to or I lecture to or whatever, and they want to wake up, but it just is too uncomfortable. So they'd rather live in the paper paradigm than take action. Because once you call the coin dealer and you get to SilverDoctors.com and you make a purchase, you've actually made a commitment that you believe there is at least some merit in what we're saying. And that's something that everyone really, if they would wake up, I've never preached, you know, do 100% gold and silver. I've never said that. But I think 10% is a minimum if you have the slightest inkling that something is wrong. Think of what would happen if 10% of the entire population of the United States woke up and put 10% of their liquid assets into the metals. I mean, what would that do to the price?
Yeah, we definitely see quite a difference in valuation from what we see today. If the U.S. public and really the Western public in general woke up and did that. And I think as this crisis progresses, I think a lot of Europe you will see do that, particularly like Germany and places like that where they do have actual memories of hyperinflation.
Well, you know, the risk in the near term of a deflationary bust is increasing because of this credit issue with the Portugal banking system. And we can see the manifestations of that to some extent in the jump into the U.S. dollar and the safe haven move trades that we see now. But you know, it's partially masked by the geopolitical. You know, in the longer term, I'm always more in the inflationary camp, and certainly when it comes to the generic definition of inflation, as you said, we certainly have had inflation in the money system. It's just that it's been largely sequestered in the United States with banking excess reserves on the Federal Reserve's balance sheet. And there, in time, you know, if you look at a longer-term perspective of a 10-year and longer window, the correlation between the increase in the monetary base and the price of gold as in the expansion of credit, regardless of where it goes, even if it's sequestered on the Fed's balance sheet, it still has a almost, you know, 90 some odd plus or 0.9 correlation to the debasement of the dollar and the rising of the price of gold. And you know, in the short term, economic laws can be turned on their head either directly by intervention or just because of strange idiosyncrasies. But in the longer term, I think that the inflation thesis is going to play out. It's just a question of whether or not we have a kind of wipeout on the near term. And it looks like the risk of something like that, the creaking of the financial system globally, is audible. You can just kind of see and hear the stresses when you have like a bank in Portugal seeing its stock getting halved today, and the counterparty risk, as described by the Wall Street Journal, is that there's some $29 billion or so directly at risk with another 120 billion or so in credit default swaps tied up to these so-called insurance positions that people are taking against Portuguese debt. And that's the recipe for a daisy chain, a domino reaction on the deflation side. And whether or not it happens is anyone's guess. But the thing is that if it were to happen, the Fed would respond, the other central banks would respond, and as you were describing with Jim Poplava's thesis, it really is just an issue of adding whatever number of zeros it takes to the electronic creation of credit to buttress the system at the push of a button. There's really only a couple of ways that the international bankers can deal with that kind of a crisis. It's a banking holiday, or it's a banking holiday and then a combination of the 1-2 punch of the creation of credit with the pushing of the keyboard. We may have something like a 2009 crash where gold and silver just get annihilated in the near term, but 6 months or so with digestion period, and then the onslaught of the creation of electronic credit into the financial systems rising, you'd see a bounce back. So I think that the store of value in gold in particular through a deflationary shorter term period will remain. It's just a question of what comes first. And unfortunately, if we did have something like a 2009 period, a whole heck of a lot of people would be very scared and jettison their insurance. They'd sell their gold out. Some people, in fact, would have to do that just because they might need nickel liquidity. And that's the scenario, I think, that is probably the most worrisome in the near term, because when you look at the news that's coming out of Portugal right now, and then you look at the price of gold and whatnot, obviously there's some manipulation because we have the geopolitical events going on now, and the FOMC statement about tapering being cut, or further tapering this week being announced. That puts pressure on gold, but I think, though it's not easy to ascribe what percentage of the decline this week has been associated with the risk of rising deflationary crash, there is some of that going on here in the financial markets. So it's worth keeping an eye on. And also just to put the cherry on the top of the theory, Bill also was basically maintaining that sometime around the turn of this year that the hoard of physical that J.P. Morgan had accumulated had already been fully used, or mostly used, in the process of them selling the physical to keep prices down, and then all the while they were profiting on the paper position that they had accumulated. So his theory being relevant now is that J.P. Morgan no longer has the physical stash to help push silver down, and that therefore at some point it's going to move a lot higher because they don't have the ability to push the market down.
Yeah, I'll make some comments. One is it's plausible, certainly. Secondly, I was at one of the major banks. Well, it really isn't banks. It's a COMEX-approved warehouse, and I was with the founder and the VP doing an inspection, and I, had a conversation with them over many topics. And the VP actually brought to my attention that J.P. Morgan had one of the largest, if not the only at the time, vaulting facility going on in Asia. And of course, it didn't alarm me, but it sort of woke me up even further, thinking that I'm somewhat awake to, what's really going on. But, here they were earlier than anybody getting a warehouse set up in Asia for physical metal. And so certainly that goes along with what you're suggesting here, is that they can move in and out of the market. Certainly in the paper markets, probably bigger and broader than anyone else. It's pretty much a given for those that follow the management of the metals through the derivatives markets. But the physical does play a very important part. And so, they were not asleep at the wheel. They were certainly there. What I have done looking at their what's in the transparent market, which you can't really draw the conclusions that I think others do. I try very much to be as objective as I can, and that is that, well, they've got this much metal. Well, you can see what they have in the transparent market when you look at the commitment of traders report, or you go to the warehouse stocks that's provided by the CME. That's pretty much indisputable. Whether those numbers are valid is not my point. I mean, that's irrelevant to what I'm talking about. The point is that we don't know what their true position is in the OTC markets, which is far bigger than the transparent market. So Bank X might have so much silver on deposit, and you see that in the warehouse receipts that are publicly displayed, but you don't really know what their other position is in, one, the physical market, and two, primarily what the derivative position is. So they could show a net short position, something in a transparent market, but actually be net long. That's my point. Now, I'm not suggesting that they are or they are not. What I am suggesting is that you are only looking at part of the big picture, and as far as I know, very few, if any, have the big picture, meaning all of the story, meaning all of the positions in the over-the-counter opaque market, combined with what's in the transparent market, combined with what's going on with the derivatives in the physical world, which is primarily done by the RTZs and the PHPs and these conglomerate mines that mine silver and could care less about the price and hand their what's called book over to these bullion banks that make a derivative on top of a derivative on top of a derivative, and when things aren't going their way, they delta hedge it, which basically forces it by paper proxy to move the direction they want. So, not to discourage anybody, because I get the question all the time, well, if they can do that now, they can do it forever. The answer is no, they cannot, because as I started with, a physical reality of an ounce of gold is, it has the same constant mass anywhere in the universe. That is also a precious commodity that's been precious forever and will remain so. And just because someone thinks that they own it because they have a piece of paper that says they have it stored in X bank doesn't necessarily mean that it really exists there. It may have been loaned out or swapped or something else. So physical reality meeting the paper paradigm, I think we're getting ever closer. They don't match. They do not match. And because they don't match, then there will be a point someplace, sometime, somewhere where people are going to wake up and wish that they had been able to touch what they think they own.
Yeah, and I think that the deviation of that mismatch is expanding, and that is, in fact, probably combined with the ongoing demand out of Asia for gold and silver secondarily, is why we have not seen the price break down below support levels that have been up and running since June 28th last year. On a related question, I'd love to know what your take is as far as this discrepancy that is visible with the open interest in silver being very high, near its recent highs for multiple years, whereas gold isn't as high. I'm speaking of COMEX, of course. What do you make of that?
Boy, it's tough. I'm not afraid to say I don't know, because there's times when, I've never claimed I knew everything about the silver market. It is a discrepancy. Normally they travel pretty much together. It could be a test case, I would think that possibly it's going to say, well, if we can't get silver any lower, then that might give them a little test for the gold market. That's a possibility. The other thing is that there might be some offing of positions onto, the dumbest guy in the room, which is just a colloquialism that's used in the derivatives world about how some of these, let's call smarter banks, or let me state, less ethical banks, are willing to write paper contracts on whatever it is and off it or sell it to somebody that doesn't really know what they're buying. So there could be some of that going on, but I'm really not sure. I wish I had a really succinct answer, and hey, this is it. Part of it could be this August 15th date that's coming up with the silver fix ending, and there's some type of paper paradigm going on that's going to protect them with some exotic trades, which you can do some very interesting thing in derivatives markets. I ought to know. I used to do some. That will be quote unquote protective of their positions with silver fix out of London that no longer exists. So I think that may have something to do with it as well. But really, to say I know or I've got a really strong opinion, I really do not.
I don't think anybody really knows, other than people like the Masters of the world. And it also gets back to that, large over-the-counter market as well too. That masks things all the more so. I mean, I've heard people describe the over-the-counter trades as being a factor of 10 times larger than what occurs on comics and LBMA and so forth.
Well, let me jump in and explore that with you a little bit, because I think we could further the idea a little bit. If you have a big OTC exposure, so you go into the CME, you've got a lot better chance of forcing the issue in the CME to take delivery of physical if you have to. And so that's why that could be increasing the volume, because it's like, well, we've got this, and this. We're only going to get called out about 100 to 1. But even if we got called out 100 to 1, here's how much silver we have to have. Hey, we better get into the CME or the COMEX and get a position on just in case. So that could be part of it. I'm guessing here, or I'm using some logic, that doesn't mean I'm right, but that could be part of it.
I wanted to give the listeners a quick update here on the physical market in the U.S. Really, across the spectrum, supply remains very good for both gold and silver, pretty much readily available, whether it's government coins, silver eagles, maples. And then we do have also coming out here, the Mexican Libertad is finally coming out for 2014, making its debut finally in the second half, as well as a couple of the smaller mints like the New Zealand mint. And also the silver eagles, the production remains strong. I believe the U.S. Mint has now sold over 26 million silver eagles so far this year. So they've been able to ramp up production to meet that increased demand, so we don't have the shortages like we saw either early 2014 or throughout most of the duration of last year, 2013. So really, I continue to believe it's an excellent time to accumulate wealth in the physical precious metals form, as not only do we have prices near the bottom continuing their consolidation, but you also now have premiums that are at levels we haven't seen in the last 5 or 10 years. All right, well, before we let you go here today, David, if you could let the listeners know where to follow your work as well as your newsletter.
Very good. The best place to go is themorganreport.com. You can get our once-a-week e-letter that's free. If you're really serious about the metals markets, you could follow us on the membership site, and it's all described on the right-hand side. If you want to just look at lectures like this, we post them on the YouTube channel, which is Silver Guru. And if you want to read daily what I think is important to read in the economic climate, you can go to Twitter and go to @SilverGuru22. So Twitter, YouTube, or the website, any of those places is a good place to find our work.
All right. It's great to have you back, David. Really appreciate taking the time and coming back on the show.
My pleasure. Thank you.
All right. For the Doc and Eric Dubin, thanks for tuning in again to the SD Weekly Metals and Markets.
Those individuals who are in charge of monetary policy around the world, I think they're very much aware of what is coming. When I've asked Federal Reserve Chairman in the committee about this, they never said, no, that's not going to happen. They use the word orderly. As long as it's orderly, it seems to be okay.